Okay, so now we're going to talk a little bit about recognizing revenue, which we've already been doing quite a bit in this class. Just now we're going to dig into it just a little bit. So what have we talked about 100 times at this point, right? Recognizing equals an increase. This is a plus typically, especially in this chapter, it's going to be an increase to revenue, right? Recognizing means we are increasing revenue, okay? So we can recognize revenue over a period of time if we meet any of the following. Okay, so this means that we're not going to recognize it all at once. We may recognize it over the course of several months, or we may recognize it over the course of several weeks, several days, whatever the case is. So this would be like when the customer has benefit of the seller's work as it is performed. So cleaning services, lawn care services, magazine subscriptions. I know that's kind of archaic now, but that was always a good example when I was a student. Magazine subscriptions, right? You subscribe to Sports Illustrated and you get one issue of Sports Illustrated a month, but you pay a year ahead of time, so they would recognize the revenue every time they sent you a magazine each month. Also, if the customer controls the asset as it's being created or built, so when they built the extension or when they updated Glass Hall here on campus, they would recognize revenue slowly as it was completed, right? Because Missouri State still had control of the building, but the work was being done on the building. This is what we call typically percentage completion. Those of you that are construction management majors will probably have to learn quite a bit of percentage completion accounting because most construction projects are accounted for in that way. So let's look at an example really quick. I think this will really kind of solidify the idea for you guys, right? So Dropbox is a company that you can, kind of a cloud service where you can store things in a cloud server. Dropbox receives a payment of $120 for annual plan that offers 1 terabyte of storage space. Again, extremely important, so always pay attention to the dates. So how many, if our year end is December, how many months are we going to have this for, right? We'll probably ask that in another journal entry. So here's what's happening. They got paid $120 in cash, right? So that's an increase to their cash asset, but it is a deferred revenue because they, let's say we are Dropbox, we still owe a service. Okay, we've not earned it. We haven't earned it, right? So we haven't earned that revenue yet. So we're increasing the liability, and that looks like this. We're going to increase assets by 120. We're also going to increase that liability by 120. As you can see right now, there is no income statement impact because we've not recognized any revenues yet. Okay. So let's say on October 31st, Dropbox recognizes 1/12 of the total amount of revenue for the 1 month of service provided. Very important that we understand this, right? So this is going to be 120 times 1/12, right? Because we're recognizing 1/12 of the revenue. 120 over times 1/12 is 10. Okay. The number of months we've had it times the number of months in the year. This is in over months in the year. Okay. So 120 times 1/12, 1/12, because we provided 1 month of service. Okay. So we are going to reduce that deferred revenue because we've earned it. Right? We no longer owe that. And we're going to increase service revenue. Sorry, this should be a plus to revenues, right? Because we have earned that $10 over the course of the month. This is what it looks like. Okay. We're going to reduce that liability there. We're going to increase our revenues here. That in turn increases net income by 10, which flows from the income statement and increases the retained earnings on the statement of stockholders' equity as well as our balance sheet by 10. Okay. The next thing we got to talk about is just a little bit trickier. We're going to talk about discounts, sales returns. Okay, so there are discounts that we have to take into consideration when we do sales before we calculate sales revenue. Now, if you remember all the way back to like week 1, week 2, we talked about net sales, right? This is what we were talking about, okay? So sometimes we will offer discounts that can reduce the amount of cash that we are entitled to receive from the customers. Why would we do that? Why would we offer those discounts? Well, typically it's because, well, if we offer you a discount, you might pay cash, which is ultimately what we want, right? We want that cash quicker. It may also increase our chances of collecting that, actually collecting the cash. If we tell you that, let's say, we'll give you a 2% discount if you pay off your receivables balance in the next 10 days, whatever the case is. We will talk about those. We will go through some examples like that. But those are just a couple of examples as to why we might offer a discount. So a sales return is when the customer returns the product. I mean, that is, you bought something at Target, you got it home, it was not what you expected, it was broken, it didn't function the way you thought it should, you just aren't happy with it, you take it back and return it to Target. They take that into consideration. That is part of their net sales figure. Not everybody will keep everything. Some people are going to return stuff. Okay. Trade discounts we'll talk about later, but again, this is just a reduction in the list price of a product or a service. It is more like an incentive for customers to buy more. So think buying in bulk, going to like Sam's Club, right? Or Costco. Those are really easy examples to think about trade discounts because you're buying 500 rolls of toilet paper or 500 rolls of paper towels, or you are buying 40 pounds of peanut butter. You're getting it at a discount, right? So sales discounts, these are reductions in the amount received from a credit if payment is received within a specified period. So what this is saying essentially is when they pay credit, we will say if you pay in the next 10 days, we will give you this amount of discount. Okay, that is a sales discount. So the terms, and these are very important. You need to be so familiar with these because we will rattle these off quite frequently in accounting. I had an accountant tell me one time that they almost got this tattooed on them, right? 210 net 30. I mean, it's just something we say constantly. And that is the way we pronounce that. This 2/10 is pronounced 210. Okay? We just say 210. When I say 210, that just means this. Okay? It indicates you're going to get a 2% discount. Okay? If you pay the full amount in 10 days. Okay? That is what the 210 stands for. When I say you're going to get a 210, that means you're going to get a 2% discount if you pay the full amount of your receivable in 10 days. Okay? The next part of that, after the comma, we say in 30. Okay? Some people say in 30, some people say net 30. It just means if you do not take the discount, meaning if you don't pay within 10 days, you're going to pay the full amount. Okay, it's basically like saying 100% if you don't pay in 30 days. Or maybe not necessarily don't pay in 30 days, but if you pay within 30 days. Okay, so we expect full payment in 30 days. Okay? So the way we say that, once again, is 210 net 30 or 210 in 30. Okay. Typically, you'll hear people say 210 net 30. That's all this means. You'll get a 2% discount if you pay within 10 days. If you pay within 30 days, you will have to pay 100% of the sales price. So, net revenues, they are your total revenues less any amounts for returns and discounts. That's what we talked about earlier. Net revenues, net sales, right? Those are kind of the same thing. It is just your total revenues less any amounts for returns and discounts. Okay. So let's cover credit sales really quickly, and then we will move on. So credit sales transfer the goods or the service to the customer today, but require the company to collect payment from the customer in the future. This is accounts receivable. We've talked about this 100 times at this point in this class, right? So we're going to debit it. We're going to increase AR when this happens, and we are going to increase revenue, right? Why? Well, because we've transferred that good or that service, we've performed the obligation, so we're going to recognize revenue. But we haven't received the money yet, so we're creating that reminder to ourselves that they owe us, right? We earned it, but they owe us. Okay? That is credit sales. We've talked about those a lot already, so you should be somewhat familiar with that concept. If you're not, if you're confused about trade discounts, sales discounts, any of that stuff, please let me know, and I will be happy to answer your questions.